Welcome to this session this morning, Developing Your Private Markets Portfolio. Our first presenter will touch on the European perspective and our second presenter on the US perspective.
Good morning. It is a pleasure for me to be here with you. My colleague Craig advised me that the way to present in Australia should be informal, but if you expect me to be informal, I will have to switch in French. So, bonjour, but don't worry, I will make the effort to speak in English, but it may be not as informal as you may expect. So I will focus my notes on real estate and Europe, even if AXA IM Real Asset is a global firm with now presence in the US and also in Australia. We have purchased the Eureka team 1 year ago. Our basis is Europe, and I assume that as Australians listening at me, you are leading the largest European asset manager, real estate asset manager. You are expecting a European angle. So I will first share with you the way we view the European market, European real estate market, and then I will also cover the way to introduce real estate into a portfolio and how we consider a real estate portfolio should be built up. So first of all, what is happening in Europe? Europe is in an attractive position in the context of the global market. As you can see, and it's not a surprise, real estate markets are cyclical, and Europe is lagging Asia, but also the US market. So it means that economy and property demand recovery is well underway in Europe. And this recovery is also, in parallel, we observe also a shift in the way tenants notably approach real estate. There is a real shift in their demand, and we see more and more demand for co-working, for services in the building. So it means that we have also to adapt to this new trend, to those demands. So for us, it means that we put a lot of emphasis in this current market on development and notably developing new premises that meet those climate requirements, those tenant requirements. If we look into more details regarding the European market, the UK is now contracting a little bit thanks to following the Brexit. Nevertheless, the investment market remain quite active, but we start to see some impact on the lettings. At the same time, France recovery in France is speeding, thanks notably to the new government, and we expect more to come following the Macron election. The European market is dominated by foreign buyers that remain very active and that have a lower cost of capital compared to domestic players that are looking at generally higher returns. And notably among those foreign buyers, you have the Asian ones that are very, very active and that are targeting trophy assets, and they are ready to pay a premium for the privilege of getting access to those assets. Since 2013, they bought property yielding on average 100 bips less than European cross-border players and 150 bips less than US players. So they really make the market, and notably the London market. And so we see, thanks notably to this play from foreign investor, a shift, a widening gap between prime and secondary assets. What does it mean for us when we consider investment? We are prudent, we are cautious, and we consider it is time, as long as we are late in the cycle, to focus on income and not to bet so much on capital appreciation. So it's really an income play. And when we are talking about income, our strong conviction is that we should, and it's what we are doing, look more at alternative asset classes. So within real estate, it means student housing, senior housing, logistics that also benefit from the boom of the e-commerce. So all those asset classes enjoy very good growth. And we also believe strongly in the residential market that benefit from urbanization. And regarding the office market, as I have mentioned, we are very cautious regarding the very prime location that are quite expensive, but we prefer to do development as it is a way for us to capture, and for our investor to capture the development margin, and also to come to the market with assets that meet client requirement, and notably all their expectations regarding services and technicalities in the buildings. So that is, we will, I'm sure, cover more about Europe during the panel and the discussion, but now how to introduce real estate into a portfolio. First of all, real estate, the benefit of real estate is that it generates some diversification compared to an equity and fixed income portfolio. And in the low yield environment, it offers attractive yield spread. It is a way when you introduce, and you can see that on the graph. When you're introducing real estate in the portfolio, it is a way to improve the efficient frontier if you had the real estate to a more traditional bond and equity portfolio. The beauty of real estate is that it offers also, it provides smooth returns during the adjustment period. The fact that there is no real mark-to-market valuation for real estate help provide stability compared to a fixed income or equity portfolio. And the other advantage of it when you introduce real estate is that there is an element of inflation indexation with real estate. And those real estate are the return are largely yield-driven, so they can be very attractive for funds when they enter into a decumulation phase. It is the case of for some Australian. So if we look at the inflation component, globally all the leases are indexed on inflation. In the UK, lease structure are indexed, and generally it is every 5 years, but they are only indexed upward. Elsewhere in Europe, you have also an element of indexation. Generally, the lease captures 75 to 100% of the local inflation index. It varies a little bit from one country to another. The sole exception to this is Germany, that have a very specific indexation system and that is less automatic. So real estate into a portfolio, it's the case for diversification, attractive yield spread, smooth return, and inflation indexation. Now, when investing in real estate, what is also of interest is to organize some diversification. You have the correlation table on these slides, and as you can see, returns correlation between countries vary, and in some cases have been quite low. So, of course, this makes the case for international diversification and reduce the home bias. And of course, this diversification benefit comes from different micro drivers, but we have also to be cautious and to pay attention to that, because during the Great Recession, some correlation went to a one level. So it depends also on where we are in the cycle. The country that provides in this chart the higher level of diversification is Germany, but we have to be quite cautious because in Germany valuation are data. The data are appraisal based, so there is no real mark-to-market. They apply what they call the sustainable value appraisals, so which is smoothing the valuation even more than anywhere else, and consequently this overstates Germany's diversification potential. But you can see that there is some quite low correlation, not just for Germany. So, of course, diversification matters, but how to calibrate a portfolio across the cycle? First of all, what I would like to share with you is the fact that we have what we call a 360 approach, meaning that we are not just looking at direct real estate, but we look at both direct real estate, so private market, and also public market, and we look at equity and debt. So we have this 4 quadrants approach, meaning that we can, invest in direct properties, private debt, public equities, and public debt. The rationale for this approach is, first of all, it gives us a better market insight, and it allows us to manage, to make some arbitrage between the various instruments, and so to monitor better the cycle. And on the top of that, this 360 approach allows us to combine instruments to tailor investment strategies, depending on investor requirements. So for investors that have more liquidity constraints, we can increase liquid buckets thanks with equity and also bonds. Bonds can be there to smooth the volatility of equities, and it increasing the bucket, the liquid bucket, of course, help to provide liquidity on the portfolio. And we also play with debt and with private instruments to smooth the volatility. So combining the four instruments, or some of them, help us to design solutions that will meet various investor expectations. So for DC pension or for unit-linked insurance company that have strong liquidity constraints, having more combining liquid bucket can be of interest. So this 360 approach helps us to have a thorough understanding of relative value, to focus on optimizing cycle management, and give us agility and flexibility in asset allocation. So we can mix liquid and various instruments in each of the strategy, and here in this slide, you have in blue what we consider the core strategy, and in red the more yieldy strategy. So the core strategy that can be made with senior debt, private debt, and core properties are to be there across the cycle. It is not a cycle play, it is an allocation play. Investors consider those assets for the income they generate, so they have to be there more or less on a stable basis across the cycle. Then you have the yieldy strategy, value-add development, opportunistic, that are definitely a cyclical play. And you will monitor your entry point depending on where you are in the cycle. So for value-add and development, you grow your portfolio across the growth phase of the cycle. For opportunistic, that is more betting on disruption, market disruption, it will be more a play for the end of the correction phase and the beginning of the recovery. So generally, when we build up portfolio, core are there with open-ended vehicle or direct mandate, whereas everything that is value-add or opportunistic have to be invested through a closed-ended vehicle, and what is important is to monitor entry point and exit. And you can see in the middle that you have this blue line, core liquid, and we consider that introducing a liquid instrument, so core liquid generally it is a mix of equities and bonds issued by property companies, and this bucket is also there to give you liquidity and to allow you to monitor your entry point when considering the more aggressive strategy. So combining all this, that's the way, let's say, we consider portfolio construction, and depending on risk appetite, we can increase more or less each bucket. Now, and to conclude, I would like to share with you the way we do our stock picking, how we select the asset. We have the portfolio model, but how we do asset selections. First of all, I have mentioned diversification, but just diversification is not just about countries, but increasingly about cities. They are the economic growth engines, accounting for about 85% of the global GDP. Paris, for example, is 16% of the French population, but 27% of the GDP, the French GDP. In 2015, 91% of US GDP was generated in metro areas, and the 10 highest producing metropolitan economies generated more than the total value output of 37 combined states. So urbanization brings infrastructure improvement and better quality of life. So this is supporting the case for large cities. And when we are talking about cities, size matters, as productivity levels is correlated to the population size. In another way, larger cities are more productive than smaller ones. So, and on the top of all this, of course, larger cities tend to have a higher share of highly educated people, which help boost their productivity. So the way we the way we select cities is, first of all, we start with the 150 largest cities. We remove from this panel, this pool, the cities with a weak rules of law. So we eliminate more or less the emerging market. Then we screen 100 cities and look at growth drivers, market transparency and supply constraints. And we are left with 40 cities that are our long-term targets. And they are spread within 5 regional groups. So it's 2 in Europe, 2 in the US, East and West, and the Asia-Pacific. That includes, of course, Sydney and Melbourne. And we have also one global group, the big giant, that is made of New York, London, Paris, London, and Los Angeles. Then, out of those 40 long-term cities, we select the short-term targets that includes cities based on current pricing and outlook for occupier fundamental. So, and in current market, and I will stop with that, but we will for sure cover more during the panel discussion. At present time, we will bet on Boston, Seattle, Madrid, Berlin, Amsterdam, that have good rental growth and that have offer less aggressive pricing compared to notably the global giants. So we are quite cautious on global giants that are quite expensive. And this model allows us to generate over a 15-year period to generate a premium of 90 bips per annum compared to the global IPD index. So from a 7.4% global IPD index, we managed to increase the return per annum up to 8.3%. So I will now let the floor to John, and I'm sure we will cover more and during the panel and answer your questions. Thank you.
Good morning, everyone. Great to be here. So my name is John Goodreds. I am with Nuveen, which is the wholly owned asset management arm of TIAA. TIAA is essentially a superannuation fund in the U.S. focused on the not-for-profit sector, primarily colleges, universities, but other not-for-profits like museums, hospitals, things of that nature. We have been investing in real assets since actually the late 1940s. I've been with the company for roughly 22 years. I've been on the alternative asset side of our business for the entire time. So I look forward to sharing a few of the things we've learned as we've constructed portfolios for our own TIAA pension account. So a couple thoughts on just the macro environment, right? So if we think about, let's say, public equities and the performance since the global financial crisis, right? It's been a pretty good run. Fixed income a little less so, but at least certainly equities have had a very strong run. And if we think about what the future is likely to hold, economic growth outlook, it's not terrible globally, right? But it's not exciting. It's kind of lukewarm, right? Kind of modest. I'm sure many of you see the same long-term capital market assumptions that I see. Public equity return forecasts, 6-7%, sort of in that ballpark, depending on the region and the strategy, a range of other factors. Fixed income returns, 3 to 5%. And then obviously widespread geopolitical uncertainties. And when I think about with that macro backdrop, more and more investors, from my perspective, I'm seeing with an interest in private real assets, but there's a couple challenges, right, in putting together portfolios. One is lack of transparency, and I don't think that's intentional, but the fact is, if you're coming from a public markets perspective and you're used to having very robust data and you can do a lot of quantitative analysis, investing in private markets is a little different, right? Because it's more of a balance between qualitative and quantitative. So it's just a little bit harder to get the same type of data as you get if you focus on the public markets. Capital requirements. Very often transactions in the private markets can be a little bit lumpier Infrastructure would be a good example. Real estate is another one. A lot of times, individual transactions are quite large, and it tends to point you toward funds because it's harder for most investors, not only from developing a staff that can do deals directly, but also from the capital requirements. Operational risks across the various asset classes. And then, of course, going back to my original point, the portfolio construction effort is a little bit challenging just because you don't have the same type of data as you have with public markets. But one of the things I'm going to try and walk you through is some research that we've done that tries to quantify a few of the benefits of adding different types of private real asset classes to a portfolio. Some of the benefits, and I'm sure most of you have seen these for quite some time, but many real asset categories, both private debt and different types of private equity, have attractive diversification characteristics. And I'll have a few slides coming up, but what that tends to mean is low or even negative correlations with traditional asset classes and with each other, and higher correlations with inflation. One of the things I think, particularly in real assets investors are interested in, is that many real asset classes have what I like to think of as both bond-like and equity-like characteristics. Bond-like in the sense that you tend to have a value that acts as a likely floor in returns, plus the potential for current income, so bond-like in that perspective, but equity-like in the sense that there's room for capital appreciation. In this slide, and I'll note, all of the slides from this point forward I've taken out of 2 different white papers that we've put together. They're available on our website, so if you don't want to take notes or it's a little hard to read, you can easily get these white papers if you like. But what this shows is, just going across the top, and this is admittedly largely a U.S. focus, but I think the general takeaways have global implications. Stocks and bonds, we looked at the Russell 3000 and the Barclays U.S. Aggregate Index. And we looked at correlations compared to 3 different types of private real assets, real estate, farmland, and timberland. And then we also added on the right side of the slide corresponding public asset classes in those same 3, real estate, agriculture, and timber. And what the numbers show, if you look across this matrix, is, as I said, low to negative correlation with public equity and public fixed income asset classes, but also low correlation with other private real assets. So we think there's powerful diversification. This has been our own experience investing on behalf of our own insurance company, General Account, which is roughly $230 billion in assets or so. What we see here is, so in addition to the diversification benefits, right, we think there's attractive risk-return characteristics. And for risk-return, we've just used a pretty straightforward Sharpe ratio. So we've looked, in this case, returns, standard deviation, and Sharpe ratios. And what we see here is attractive risk-adjusted returns for private real estate, for private farmland, and for private timberland. And you can see those in the middle. Farmland, as an example, 1.32. Now, I would say that the period of time that farmland covers in this study had very high returns, which I don't think are going to be replicated. We think of farmland as more of a 8 to 10% net unlevered IRR asset class. It's historically been a little higher than that, but I think there are some unusual reasons for that. So what we've done here, and I realize that there's a lot of data on this slide, and I just want to make a couple of key points here. So on the left, what we did was we ran a pretty standard mean variance optimization, optimizing for risk-adjusted returns. And over the period 1992 to 2016, which is a period that covers a lot of different investment cycles, economic phases, geopolitical events, sort of the mean optimized portfolio, 89% fixed income, 11% equity. And then we took a look at, well, if we were just going to add farmland, and now I'm looking at the second circle, how would it look? And so the results came out at a 43% allocation of farmland. Now, obviously, investors aren't going to do that, but it just sort of shows how powerful farmland returns have been over this period of time. The third circle, the one in the middle, it was the same exercise, but with timberland. As you can see, very healthy allocation to timber of 27%. And then fourth, for real estate, was at 31%. Now, trying to put some more realistic constraints on it, what we did in that last circle is we said, well, how about if we held allocations constant at 5% to private real estate, private farmland, and private timberland, how does the portfolio look in that kind of a scenario? And what we see is a very attractive risk-adjusted return of 1.14, and I would compare that to the circle on the left, which is just public equity and public fixed income at 0.84. So we do think there's powerful reasons beyond diversification and also risk-adjusted returns for adding private real assets. This slide's similar in the message I'm trying to get across, but what we did is instead of trying to start off with a portfolio where we tried to optimize risk-adjusted returns, we tried to use what I think is probably more realistic, probably what more of us are doing. The circle on the left is saying, okay, if I have a 60-40 portfolio of equities 60%, bonds 40%, and I want to add an allocation of 5% to each of real estate, farmland, and timberland, how does that look? And that comes out to a Sharpe ratio of 0.59. The middle circle, we did the same exercise, but we said instead of private market exposure to those three asset classes, what if we added public market exposure? And what we see is a lower risk-adjusted return, Sharpe ratio of 0.47. And then the last circle is what if we added both public and private? And what it shows is that's better than the public only, but it's less than the private only. So because we have very long-term liabilities, not dissimilar to many of yours, I'm sure, we've leaned toward the private real asset exposure. In this, what we've done is, and again, we're just trying to show a lot of different examples, a lot of different portfolio possibilities on why we think private real assets can benefit portfolios. In this case, the circle on the left, we said, let's assume here's a conservative portfolio, 20% stocks, 80% bonds. And then the circle to the right, how would it look if we just had, let's say, a 10% allocation to private alternative investments? Again, real estate, timber, and farmland. And what we saw is a substantially better risk-adjusted return. We went from a Sharpe ratio of 0.8 to a Sharpe ratio of 0.96. The two circles on the right, it was a similar exercise, except we flipped the starting point. We said, how about a more aggressive portfolio that was 80% public equity, 20% public fixed income? If we add those same real asset classes to that portfolio, how does it look? And once again, you see a pretty meaningful improvement to the Sharpe ratio, in this case, from 0.4 to 0.5. And now I'd like to talk a little bit about infrastructure. Infrastructure is something where we've been investing actively for about 20 years now. We tend to think of infrastructure in 4 different buckets, public and private, debt and equity. We're active in all 4. And so some of the slides I'm going to talk about now will address each of those points. So what we see here across the top is we see different indices looking at infrastructure, private equity, infrastructure, public equity, and then public and private debt also focused on infrastructure. And what we see is low correlations to traditional asset classes. In this case, we happen to run it against U.S. equities, but the S&P 500, also U.S. investment-grade bonds. We looked at non-U.S. equities, and we looked at private real estate. And what we saw were, once again, attractive diversification potential for adding all 4 categories of infrastructure. And then my last slide, I want to spend just a couple minutes here, is this is similar to the real estate, farmland, timber slides, where we're looking, again here, at risk-adjusted returns. And you can see on the private equity and the public equity, the Sharpe ratios of 0.6 and roughly 0.47, respectively. Private debt and public debt in the infrastructure space has actually had very nice risk-adjusted returns. You can see across the top of the page, I mean, the absolute returns have been quite different, but there's been very low volatility, as you'd expect. And we also compared that to the Sharpe ratios in investment-grade bonds and equities, both U.S. and non-U.S. And I think what you can see is, the U.S. equity and non-U.S. equity, just very substantial volatility, right? No surprise there, but lower Sharpe ratios than equity exposure to infrastructure, whether you chose private or public exposure levels. So when I step back and think about how we've constructed a portfolio for TIAA, we've added all of those asset classes. We haven't added much by way of public infrastructure or public infrastructure equity, I should say, or public infrastructure debt, just because we're longer-term investors. We have investment teams with those capabilities. We have third-party clients who are active in those spaces, so we like to offer them. We find having capabilities for all four has a lot of synergies. Our four infrastructure teams, as you would expect, talk quite regularly and help each other with ideas, sectors, diligence, et cetera. So I think that is, yeah, that's it. Happy to turn it over for questions. Thanks.
Well, I'm pleased to say we do have some questions coming through on the app. Please keep that happening, or else we will also take questions from the audience. But first question that I'll pose to the panel is, real asset returns look good historically. As interest rates normalise, do you expect that to continue? So perhaps Isabelle, you might want to...
What I have said is that we are late in the cycle, and of course the big risk could be a significant or a disorderly exit of the quantitative easing policy, and that could impact significantly interest rates. Nevertheless, so it is something, of course, we have to monitor, and that's why in the current market we are cautious, and notably looking at income and asset classes that should generate income growth. So of course it is something we have to monitor carefully. What we can normally, if we should expect increase in interest rate, it should mean that we should also see some growth and some inflation coming back. And as real estate lease and also infrastructure are indexed, have a quite good indexation on inflation, we have a natural protection. So the big risk is that this increase of interest would come without sufficient growth, but if growth is there, the asset class should go through this situation and not in portfolio limitedly impact. But for sure, at present time, looking at assets that are priced at 3.5%, where it's the case in New York or in Paris or in London, for the very, very core asset, it's very aggressive. And if you face interest rate increase with this kind of asset, it will be very, very important. So that is why we are more looking at alternative asset classes, and also doing a lot of development, as it is a better protection to in case we have to anticipate a sharp increase in interest rate.
Thank you, John.
Yeah, it's a good question. It's something we take a lot of time thinking about, and I think what I'd say is I'm sure all of us in the room have seen. You can choose your real asset category: real estate, infrastructure, private credit. I think returns have been compressing, over the last 3 to 4 years. And the way we think about it is, if we just take infrastructure as an example, if you think core returns might be in the, let's speak broadly, 6 to 8% range, and perhaps value added maybe 8 to 10%. If you think those are reasonable ranges, and you say, well, gee, those are less than I earned historically. Okay, fair enough. But what do you think public markets or other opportunities are going to look like? I mean, as I said, if you think public equity markets are likely to return in the 6, 7, 8% range, and you think fixed income markets, 3 to 5% or thereabouts, right? Those returns start to look pretty attractive. Plus, you get the benefits of diversification, the benefits of, in infrastructure, an example, income generation. A lot of the contracts, of course, have inflation escalators, so you get some inflation protection. I think the outlook for returns in many private real asset categories relative to public market returns, I think, continue to look pretty attractive.
Thank you. Another question that we've received is, what do you feel is the role for real assets as Australia enters the decumulation phase in its superannuation funds?
Yeah. So that's interesting because it's somewhat applicable to how we think about managing our own pension. And I think the answer is they absolutely have a role. And the allocations to pools of capital, that we would call it in our payout phase versus our accumulation phase. But the allocations in that pool remain, but they're typically less than the pools where there's the accumulation. And I think what's important is to really define your objectives and what you want to get out of your private real asset exposures. Income generation, or do you want to avoid volatility or correlations? But in my mind, they absolutely have an important place in that portfolio. It's just a question of the allocation.
And I think the inflation protection is, of course, make the case for introducing real estate or infrastructure into a portfolio, at least for the one for those in decumulation phase. And on the top of this, even if there is no duration, really, it's difficult to monitor the duration attached to real estate. There is we are talking about very long-term cash flow. It is the same for infrastructure, so of course it matches pretty well the need for of those funds. So for long-term inflation index assets. And what is also interesting is for those funds introducing private debt, real estate or infrastructure that can be long term is also of interest, as it introduces some duration into portfolio with higher yield than what you can get with a pure fixed income portfolio. So when you look at the annuity book in the UK, they are over allocated to real estate debt and also to real estate, thanks to this inflation protection and long-term cash flow.
Isabelle, we have a question particularly to Europe. What are the prospective returns you see for European core property markets looking forward?
So it is more or less the same question as the one regarding interest rate. When we see core properties trading at 3.5% in the city center of London or Paris, this is very aggressive pricing, and the risk in case of interest rate increase is there. So I think, especially for the UK, following the Brexit, buying very core property currently at this level of pricing, and those levels of pricing are notably supported by the aggressivity of the Asian investor, is quite challenging. And it is more or less the same in Paris. You see properties trading at 3.5%. I think what is even more for me questionable is probably to see the same pricing in Germany. As in Germany, you have no city is a big giant, so it's more we are talking about cities that are smaller. So buying at 3%, it means that you have to have a very, very strong conviction on the fact that inflation and growth will be there and continue. So at present time, it is the case in Berlin. The rental market is growing quite fast in Berlin, but the growth will have to be sustainable in order to absorb any shock, starting with yield at 3.5%. So once again, First of all, we do not anticipate a sharp increase in interest rate quite rapidly, so the market should continue to be quite aggressive. Nevertheless, being cautious, we prefer at present time not looking at those assets trading below 4%, even in Paris. Of course, in Germany it is even more challenging considering the structure of the market, but in Paris or in London, it is definitely something that is questionable in my view. So, yeah, our answer is more look at asset classes that offer better growth, stable income, better prospects, and that are trading not at those levels, but with more headroom, so at higher yield.
A question for John particularly, where do you see the opportunities for agriculture and farmland?
So we think about investing in the ag space in, from two perspectives. And one is sort of a core strategy and the other is a more value add. And the core strategy for us is farmland. And we think about farmland portfolios from a global perspective. So the portfolios that we create have exposure. I mean, the three key farmland markets we invest in are US, Brazil, and Australia. We're commonly asked if we would do a separate account in a single country. We don't. There are risks in agriculture that are, we think, best mitigated by having global diversification, right? There's weather risks, and there are, pest and disease risks, and other types of issues. So we think about putting together farmland portfolios that are globally diversified, vary by both row crops and permanent crops. So row crops, corn and soybeans and wheat. Permanent crops, things that grow on trees and vines. We tend to construct portfolios that are probably 3/4 row crop, quarter permanent crops. We vary across crop types that are grown in both row crops and permanent crops. So again, the key is the way we think about it is diversification. There are certainly strategies out there where if you're willing to make a specific bet on a particular crop or a particular region, right, there's growing numbers of managers out there that'll do that for you. There are far fewer managers that'll put together a global portfolio. That's how we think about executing a core ag strategy is global farmland. What we also do is we have more of a private equity style of investing in operating companies in the ag value chain. So this might be input companies such as seeds or manufacturers of irrigation equipment. It might be protein production. It might be processing. It might be storage and distribution. What we're seeing is increasingly more food being grown in areas being needed to be processed, stored, and transported to areas where the demand is happening. Australia, Brazil, US, all very strong export nations, right, with robust agricultural infrastructures capable of exporting significant amounts of food to growing markets, right? So that's how we think about it from both a core and a value-add perspective.